Intuit just delivered the kind of quarter investors normally celebrate. Revenue reached $4.35 billion, up 14%, while adjusted EPS came in at $4.03, comfortably above expectations. Yet the stock fell sharply after hours because Wall Street was not really trading the quarter. It was trading the future. Intuit guided fiscal 2027 revenue growth to only 9% to 10%, versus roughly 14% this year. So the market is asking a much more important question: is Intuit temporarily sacrificing growth to build something stronger, or has its growth engine fundamentally slowed? Before discussing the disappointment, the strength deserves recognition. Intuit generated $4.35 billion of fourth-quarter revenue, beating the roughly $4.27 billion consensus, while adjusted EPS of $4.03 exceeded expectations near $3.59. Full-year revenue reached $21.45 billion, up approximately 14%. This was not a weak operating quarter. In fact, QuickBooks and Credit Karma continued to provide meaningful momentum. The problem is psychological. Investors increasingly value the forward trajectory rather than the backward-looking beat. When expectations shift from, "Can Intuit deliver?" to, "How fast can Intuit grow from here?" even excellent results can produce a negative reaction. The real shock came from fiscal 2027 guidance. Intuit expects revenue between $23.28 billion and $23.51 billion, representing only 9% to 10% growth. Wall Street was looking for roughly $23.7 billion. That creates a clear expectation gap. More importantly, the slowdown is not being presented as a temporary macro problem. Management is deliberately changing the growth equation. Intuit wants more customers, greater market share and a broader ecosystem, even if that means accepting lower revenue per customer today. This is why the earnings reaction matters. The market is not saying Intuit cannot execute. It is saying investors are no longer willing to automatically pay for growth that has not yet been proven. The market's reaction becomes easier to understand when we look at the growth trajectory. Intuit delivered approximately 14% revenue growth in fiscal 2026, but the new outlook points toward 9% to 10%. That is a meaningful step down for a premium software company. And the stock had already fallen more than 44% this year before the earnings report. So investors were already questioning whether Intuit's historical growth premium was justified. The new guidance reinforces that concern. In market psychology, a beat is often irrelevant when the forward number resets expectations. Investors are effectively saying, "Show us the next growth engine before we restore the old valuation premium." There is an important counterargument. Intuit's core business is not collapsing. Global Business Solutions revenue increased about 14%, while QuickBooks Online accounting revenue grew approximately 20% in the fourth quarter. Earlier in fiscal 2026, QuickBooks Online had also been growing above 20%, supported by customer growth, pricing and mix. This is critical because QuickBooks sits inside a broader ecosystem of payroll, payments, lending and financial services. The more customers Intuit attracts, the more opportunities it has to monetize each relationship. So the current problem is not that the core platform has suddenly stopped working. The bigger issue is whether Intuit can keep expanding the platform fast enough to offset weaker businesses and slower monetization elsewhere. This is where the strategy becomes controversial. Intuit expects TurboTax growth of only 2% to 3% in fiscal 2027, down sharply from approximately 7% in fiscal 2026. Why? Because management is changing pricing and acquisition tactics to attract more customers. In simple terms, Intuit is willing to make the first transaction less profitable if that customer can later be monetized across a broader financial ecosystem. That is strategically rational, but financially uncomfortable. Investors can see the immediate revenue sacrifice, they cannot yet see the future lifetime value. This creates a classic market psychology problem. Management is asking shareholders to believe in a payoff that is further away, while the cost appears immediately in the income statement. The market is also reacting to the earnings implications of this transition. Fiscal 2027 adjusted EPS guidance is only $22.88 to $23.12, substantially below Wall Street's roughly $27.30 expectation. But there is an important accounting change behind the headline. Intuit will now include approximately $5.81 per share of stock-based compensation in its adjusted EPS presentation. So the apparent EPS collapse exaggerates the underlying operating deterioration. Still, the broader message is negative for near-term profitability. Customer acquisition, restructuring and investment in the next growth phase create pressure before the benefits arrive. Investors are therefore being asked to accept both slower revenue growth and weaker reported adjusted EPS at the same time. Intuit's slowdown is also revealing where the portfolio is becoming less balanced. Mailchimp is expected to be roughly flat to down 1% in fiscal 2027, while desktop products continue to decline. That matters because these businesses can dilute the growth rate of Intuit's stronger online ecosystem. The company is responding by separating Mailchimp reporting, making its performance easier to evaluate. From an analyst perspective, this is actually useful. It allows investors to distinguish between a healthy QuickBooks platform and businesses that are becoming structural drags. The question is whether Intuit's faster-growing businesses can become large enough to overwhelm these weaker assets. Right now, the answer is not yet obvious. This may be the most important strategic message from the report. Intuit is consciously prioritizing customer acquisition and market share expansion. CEO Sazen Goodarzi said the company is focused on scaling its big bets, accelerating customer growth and creating a stronger foundation for durable long-term growth. That tells investors the current slowdown is partly intentional. The company is not simply forecasting weaker demand, it is changing its behavior. The risk is execution. If lower pricing attracts high-quality customers who later adopt payments, payroll, lending and other services, lifetime value could rise. But if customers simply pay less without expanding their relationship, Intuit has traded profitability for volume. That is the bet Wall Street is questioning. There is another layer investors should not ignore. Intuit is trying to redefine itself around AI. The company says its platform combines proprietary data, AI capabilities, applications and human expertise to automate financial workflows and deliver what it calls done-for-you experiences. Earlier this year, management announced a major organizational reset and emphasized scaling its AI-native platform. Intuit has also been expanding conversational AI and deeper workflows for mid-market customers. This could become strategically powerful because Intuit owns the customer relationship, financial data and distribution. But AI is currently more of an investment thesis than a demonstrated financial catalyst. Until AI visibly accelerates customer growth, monetization or productivity, investors are likely to remain skeptical. And this is where the stock psychology becomes particularly interesting. Intuit has already established that it can grow revenue, raise prices, and expand margins. What investors now need to see is evidence that the new strategy actually improves the long-term economics of the platform. Are new customers sticking? Are they adopting additional services? Is AI increasing engagement? Can QuickBooks continue growing near 20% while weaker businesses shrink? These are more important than another quarterly EPS beat. The market has moved from "Can Intuit execute?" to "Can Intuit reinvent its growth curve?" Until those answers become measurable, the stock may continue to trade with skepticism despite the company's strong underlying franchise. So we arrive at the real debate. The bearish interpretation is straightforward: Intuit's growth is slowing, TurboTax is becoming harder to monetize, Mailchimp remains weak, desktop is declining, and AI may not offset these pressures quickly enough. The bullish interpretation is different. Management is deliberately resetting the model, investing in customer acquisition, expanding the ecosystem, and using AI to create a more valuable platform. Both interpretations fit the current evidence. That is why the next few quarters matter so much. If customer growth accelerates and ecosystem monetization follows, today's slowdown could eventually look like an investment phase. If not, Wall Street may conclude that the old Intuit growth model has permanently changed. The key takeaway is surprisingly simple: Intuit did not have an earnings problem, it has an expectations problem. The quarter was strong, QuickBooks remains healthy, and the company crossed $20 billion in annual revenue. But management is now asking investors to accept slower near-term growth while it rebuilds customer acquisition, expands AI capabilities, and strengthens the broader ecosystem. That makes execution the next catalyst. The upcoming Investor Day on September 17th could become particularly important because investors will want more detail on how these big bets translate into durable growth. For INTU, the question is no longer whether the business is good. The question is whether management can turn today's strategic sacrifice into tomorrow's growth acceleration. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.